During the market crash of 2008, the average investor lost 50% of their portfolio value. Meanwhile, a small group of disciplined investors actually grew their wealth by 27%. What separated them wasn't access to information, it was their mental approach to chaos. The average person checks their investment portfolio 7 times per day during market volatility. How often did you check yours during the last correction? And more importantly, did those checks improve your decisions or simply multiply your anxiety? When Marcus Aurelius wrote his private journals nearly 2,000 years ago, he wasn't thinking about financial markets. Yet his philosophical approach has become the secret weapon of the world's most successful investors. The Stoics understood something fundamental about human nature. We aren't wired for rational decision-making under pressure. Our ancient survival mechanisms, fight, flight, freeze, take over precisely when cool analysis is most needed. In today's video, I'll share 7 Stoic principles that have helped investors maintain focus while markets spiral into chaos. These aren't just theoretical concepts, they're practical tools used by billionaire investors like Ray Dalio, Howard Marks, and Warren Buffett, even if they don't explicitly call them Stoic. Before we dive in, remember to subscribe and hit the notification bell. Financial wisdom is most valuable before you need it, not during the crisis. The cornerstone of Stoic philosophy is the dichotomy of control, the razor-sharp distinction between what we can influence and what we cannot. Epictetus, a former slave who became one of Rome's greatest philosophers, taught, "Some things are within our power, while others are not. Within our power are opinion, motivation, desire, aversion, and in a word, whatever is of our own doing. Not within our power are our body, our property, reputation, office, and in a word, whatever is not of our own doing." When applied to investing, this principle is transformative. You cannot control market movements, interest rate decisions, geopolitical events, other investors' panic company earnings, surprises, but you absolutely can control your asset allocation, investment time horizon, information consumption, emotional responses, decision-making process. Ray Dalio, founder of the world's largest hedge fund, Bridgewater Associates, applies this Stoic principle religiously. He says pain plus reflection equals progress. Instead of fighting market reality, he accepts it and adapts his strategy accordingly. During the 2020 pandemic crash, investors who focused on what they couldn't control, the virus spread, lockdown timing, economic damage, made panicked decisions. Those who focused on what they could control, their asset allocation, buying opportunities, maintaining long-term perspective, emerged stronger. Action step. Before your next investment decision, write down what factors are within your control and which aren't. Only act on the former and practice radical acceptance of the latter. The Stoics practiced an exercise called premeditatio malorum, the premeditation of evils. Far from pessimistic, this practice builds resilience by mentally rehearsing potential difficulties. Seneca advised, "The man who has anticipated the coming of troubles takes away their power when they arrive." This doesn't mean living in fear. It means removing fear's power through preparation. In investing, this translates to scenario planning. Howard Marks, co-founder of Oaktree Capital Management and worth over $2.2 billion, credits his success to this approach. You can't predict, but you can prepare. Instead of hoping crashes never happen, Stoic investors mentally rehearse their response to 20%, 30%, or even 50% drops. Set predetermined buy points for quality assets during crashes. Create decision rules before emotions take over. Maintain cash reserves for opportunities. Practice emotional detachment from temporary losses. One dramatic example comes from Bill Miller, who maintained focus during the 2008 crisis to make over $1 billion on Amazon stock. While others panicked over short-term losses, Miller had mentally prepared for extreme volatility in high-conviction positions. Warren Buffett embodies this principle with his famous instruction: be fearful when others are greedy, and greedy when others are fearful. This counter-cyclical approach requires mental rehearsal of market extremes. Action step: write down exactly how you'll respond to a 30% market drop. Specify what you'll buy, how much cash you'll deploy, and what you'll tell yourself to stay focused. The Stoics practiced voluntary discomfort, deliberately experiencing hardship to build resilience. Seneca, despite being one of Rome's wealthiest men, would practice living as if he'd lost everything. Set aside certain days on which you shall be content with the scantiest and cheapest fare, with coarse and rough dress, saying to yourself, "Is this what I feared?" For investors, this principle manifests as deliberately exposing yourself to small losses and discomfort before markets force larger ones upon you. Stanley Druckenmiller, who's generated over 30% annual returns across decades, practices this by taking small, calculated losses frequently. The best way to build confidence is to get hit in the mouth a few times and realize it's not fatal. Stoic investors build resilience through maintaining small positions in volatile assets, studying historical crashes in vivid detail, practicing opportunity identification during downturns, deliberately selling some positions at a loss to overcome loss aversion, calculating maximum drawdown scenarios. Regularly, Ray Dalio famously subjects his investment theses to stress tests, deliberately trying to break them before markets do. This stoic practice of seeking discomfort builds anti-fragility. Action step: identify one area of financial discomfort you've been avoiding, reviewing your total losses, calculating your true net worth, analyzing your worst investment. Confront it this week. The Stoics practice the view from above, mentally zooming out to see events from a cosmic perspective, reducing their apparent importance. Marcus Aurelius wrote, "Think of the universal substance, of which you have a small portion, and of universal time, of which a short and indivisible interval has been assigned to you." For investors, this perspective shift means zooming out from daily price movements to see broader patterns of market cycles. Seth Klarman, founder of Baupost Group with $30 billion under management, applies this principle. The stock market is the story of cycles and of the human behavior that is responsible for overreactions in both directions. Stoic investors practice this principle by reviewing 30-year market charts regularly, studying historical market cycles across centuries, placing current volatility in historical context, maintaining physical reminders of previous world-ending crashes that didn't end the world, limiting consumption of minute-by-minute market commentary. Charlie Munger, Warren Buffett's partner, embodies this approach. If you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder. Action step: create a market perspective document showing how the S&P 500 has performed through major historical crises: World War II, Cuban Missile Crisis, 1970s inflation, 2008, etc. Review it monthly. The Stoics began each day with preparation and ended with reflection. Seneca wrote, "When the light has been removed and my wife has fallen silent, aware of this habit that's now mine, I examine my entire day and go back over what I've done and said." This discipline creates space for deliberate decision-making rather than reactive behavior. Ray Dalio implements this in his daily reflection practice, where he examines trading decisions without emotion. His team at Bridgewater documents their thought process before making trades, then reviews outcomes dispassionately. Stoic investors practice this by writing investment theses before purchasing assets, documenting emotional states during market events, reviewing trades against original rationale, maintaining a lessons learned investment journal, separating results from process in evaluation. Jack Bogle, founder of Vanguard, advised this practice. Time is your friend, impulse is your enemy. Daily reflection minimizes impulsive decisions during market chaos. Action step: create a simple 2-column investment journal. Before any purchase, write your specific thesis with buy and sell criteria. Review monthly against actual results. The Stoics practiced amor fati, love of fate, embracing whatever happens as necessary and beneficial. Epictetus taught, don't seek for events to happen as you wish, but wish events to happen as they do, and your life will flow well. In investing, this transforms how we respond to losses and market crashes, seeing them not as catastrophes, but as necessary components of functioning markets. Peter Lynch, who generated 29% annual returns at Fidelity Magellan Fund, embodied this principle. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Stoic investors practice amor fati by reframing crashes as rare buying opportunities, calculating the mathematical necessity of downturns, viewing losses as tuition in the market's education, maintaining a bargain watch list for market drops, celebrating volatility as the source of returns. Howard Marks puts it simply, we wouldn't have returns if we didn't have risk. This stoic acceptance that downside and upside are inseparable creates psychological freedom. Action step: create a market opportunity fund with specific rules about when to deploy capital during downturns. Pre-commit to viewing crashes as welcome events. Perhaps the most powerful Stoic practice is memento mori, remembering death, maintaining awareness of life's finite nature. Marcus Aurelius wrote, "You could leave life right now. Let that determine what you do and say and think." For investors, this creates proper time perspective and immunity to market hysteria. Charlie Munger, at 98 years old, embodies this principle with his famous line, "All I want to know is where I'm going to die, so I'll never go there." His mortality awareness creates extreme patience and focus. Stoic investors practice memento mori by creating multi-generational wealth plans, maintaining investment time horizons that exceed their lifespan, ignoring short-term market noise, focusing on legacy rather than temporary gains, confronting risk of permanent capital loss rather than volatility. Jack Bogle advised investors to imagine you have no ability to see the prices of your investments for the next 5 years. Under those conditions, what would you do differently? Action step: write an investment legacy letter to someone 25 years younger than you, explaining what you've learned about maintaining focus during market chaos. The Stoic approaches we've explored today aren't just philosophical concepts. They are practical tools used by the world's most successful investors to maintain focus while others panic. The market will test your resolve again and again. But as Epictetus taught, it's not what happens to you, but how you respond to it that matters. I challenge you to implement the Stoic Market Journal for the next 21 days. Each morning, document your current market emotions. Note one aspect of investing outside your control you're accepting today. Record one action within your control you're taking. Each evening, review your decisions against your principles. Share your experience with this challenge in the comments below. For deeper exploration of philosophical approaches to wealth building, subscribe to our channel and click the notification bell. Remember, The market will always fluctuate, but your principles determine your results.